From New York City, for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, global bonds rallying hard to end the week, even as hawkish central bankers take the stage, all while investors weigh the opportunity costs. We begin with the big issue. Is inflation or recession the biggest risk?
We're facing still, globally, a serious inflation problem.
Core inflation remains quite high.
You've got to see some abating of that inflation.
Central banks feel compelled to attack that aggressively.
Central banks have had to come back to the table.
This is clearly a hawkish tone from the UK and from Norway.
ECB and Bank of Canada.
The most hawkish pause I could have imagined.
The question is, will they call victory at 3%?
We're not clearly at the end of the tightening cycle.
Clearly, rates have to go higher from here.
We are only now getting to tight policy.
The monetary tightening will trigger recession.
All of the empirical evidence, the surveys, are all pointing to recession.
The recession risks here are growing.
The recession will happen.
Recessionary headwinds are going to catch up with us.
With the Fed and all these other central banks having tightened policy so aggressively, it does start to bite, and it is starting to bite.
Joining us now, I'm thrilled to say, we have Oksana Aronov of JPMorgan Asset Management and Laird Landmann of TCW. Laird in LA, Oksana on set with me, so I'll start with you. Seems like we entered this week where it was pretty clear that inflation was enemy number one. Now we got some soft PMIs from the Eurozone this morning, also from the US. In your view, are we anywhere close to the point where central bankers start to focus more on the risks to growth rather than inflation?
So I think that a lot of people answer that question from the standpoint of what they would like the central bankers to do. And I think we really have to get into the head of central bankers who, of course, without a doubt, have lost so much credibility in 2021 and early 2022 with the whole sticking to transitory, that now they really have to demonstrate the heft they're willing to bring to this inflation fight. And without a doubt, you still have tremendous examples. For example, the UK earlier this year. What happens when you fall behind in the fight with inflation? So I don't think any central banker wants to make that mistake. So absolutely, I think inflation remains enemy number one. If you look at core inflation, it hasn't essentially budged on an annualized basis for the last 6 months. And if you look at core services inflation, it's actually higher than where the Fed started to fight inflation. So I think this this remains really the problem number one for them. And it's really hard to point to anything in this economy and say, this is recession right here.
Mm-hmm. Well, Laird, in trying to get in the head of central bankers, it's probably helpful that we keep hearing from them. We heard from Jerome Powell earlier this week on that 2% target. Let's take a listen.
It is working families who suffer most directly and quickly from high inflation, and it is for the benefit of those people and all other people that we need to restore 2% inflation in this country on a sustained basis.
2% on a sustained basis. If you look at headline CPI, we're around 4% right now. What does the path back to 2% on a sustained basis look like?
It's a lot longer than maybe Jerome's giving it credit for at this point. I think that there are really sticky elements that we have to overcome now that involve wages, service industries, areas that are still, doing very well, like travel, where there's a lot of demand. I think it's going to take a while for us to get down to 2%. I think that the path is going to be encouraging, but as we look around out there, what's built into the market pricing, when you look at tips with break-evens of anywhere from 211 to 230, we think that that's not in the next year sort of time frame for us. So I think that we're going in the right direction, and I think it'll probably cause various central banks this slowness to overcome services inflation. It will cause some of the central banks, I think, to go a little farther than they otherwise would have and tip us towards recession.
Let's talk about TIPS, which you bring up. I was looking at your notes. I was delighted to see that you highlighted the iShares TIPS ETF. Of course, the ticker there is TIP. If you look at the demand, it really hasn't been there. I mean, that ETF is on track for $1.5 billion of outflows this year with the inflation that we're dealing with. I mean, are you surprised to see that investors aren't reaching for TIPS?
It is a little surprising, but they've been very disappointed. I mean, if you were calling for inflation in 21 and 22 and you reached out and bought a lot of tips as an individual investor thinking that would be a good hedge, it really didn't work out well at all because real rates dominated the return, and real rates went from being negative to today being at around 1.6%, according to the tips market, and you got killed. In many cases, you underperformed nominal treasuries of similar maturities by owning tips. So it really has been a bad ride, and it's not surprising to see sort of the retail side of the equation bailing out of the ETF at this point. We actually think tips now represent pretty compelling value at TCW.
So pretty compelling value at TCW. What is the JPMorgan asset management view on tips? As Laird just laid out, they haven't really done super well in this inflationary environment. Do you think that they make sense here, or are there better inflation hedges?
So I answer that question from the standpoint of an absolute return-oriented investor, which is somewhat different from a more benchmark-aware investor, right? So my neutral point for risk is essentially liquidity. So when we don't feel there are enticing opportunities in the market, we will retreat back into liquidity until such time that there are opportunities that we feel we're being compensated for adequately. And today, there's really a dearth of those, and tips do not really represent a tremendous opportunity in our opinion, because the duration, and they do tend to be longer duration instruments, absolutely is going to dominate the risk there. And to the extent that we believe the Fed is going to continue to either kind of be on that pause or even hike further, these are not going to be immune to that interest rate risk. So we think that there is much better value right now in combining, having some dry powder in your portfolio, which is, you're earning 5+% at that very, very front end of the curve, and then attacking opportunities as they arise, which certainly we've seen some in credit-related markets, not as much as we think will come our way over the next 10, 12, 18 months as we start to approach those maturity walls in credit, as the consumer perhaps turns over, which we have not yet seen, as some of these commercial real estate issues come to pass. So there are going to be really, really attractive credit-related opportunities. But right now, have powder dry, preserve optionality for when that happens.
Let's talk about that dry powder, because one of the reasons I was so excited to talk to you today is I know that in your portfolios, you love cash, to put it bluntly there. And then you look at some of the money that's been coming out of money market funds. I believe, according to ICI data, we're on track for 2 straight weeks of outflows there. What is sort of the bull case for cash right now? Which feels a little silly to say, but what is the value proposition?
So we don't necessarily love cash when the opportunity is there to deploy your capital for, interesting returns, great returns. In today's market, however, whether you look at interest rate risk or credit-related risk, you're just not compensated for the risks, right? So if you're moving out on the curve and deploying that cash into longer duration instruments, you're essentially immediately incurring 150 basis point roughly drop, at least, depending on how far you go. And that's just not compelling to us because, again, we believe the Fed is not going to deliver the cuts that are still priced into this market, still priced into that longer end of the curve. So you will continue to be very well compensated at the very front end of the curve, which, for us, that's a fixed income asset class. And then from a credit standpoint, when you look at what are you being compensated for, some of the worst quality companies out there, the junk-rated companies, double Bs are yielding in the 6s, and cash is giving you 5 1/4. So really, do you want to take that dry powder and deploy it into that part of the market? And even overall, when you look at high yield credit, where yields are in the 8%, it will only take about 120 basis points of widening there to wipe out that very juicy yield, which is very quickly, it's something that can happen very, very quickly in high yield. So do we see opportunities? Have we seen opportunities? Yes, we've seen opportunities in bank-related paper on the back of some of the stress created both in regionals as well as Credit Suisse being pushed into the arms of UBS. So there were things to do there with IRRs of 20 to 30%. But we think that that's just the beginning of the effects of higher rates for longer, and there will be more and more opportunities like this as we go through the next 10 months.
Well, Laird, weigh in on that. How are you thinking about, 5% yields at the very front end, no duration risk, versus maybe the opportunity costs of being in cash overweight here?
Yeah, we never think of this as rocket science. The cycles play out in a reasonably predictable way. This has been a much faster, violent cycle than we've seen in a long time. But the next moves, the next sustainable moves are probably, whether it's the end of this year, beginning of next year, is that monetary policy working with a lag will cause a slowdown in the U.S. economy. We will get a turnaround. The curve will at some point renormalize. Volatility will come down. Interest rate volatility will come down. So there's a lot to do for institutional investors out there. You want to be positioned in the short end, but you want to have a lot of duration also. So there's a variety of techniques you can use to do that. That's the way TCW is positioning right now. We're trying to basically get as much exposure to sort of 1 year to 3 year parts of the curve as possible, but still maintain a longer than average duration, because we do think that the long-term price action is going to be favorable. That is, rates will be coming down over the next couple years. We don't think 1.6% real rates is sustainable for economies that have 300% plus leverage on them, as the Japanese have proved. And so, we think that those are the trends you want to look for. That is, renormalization of the curve, long-term rates coming down, volatility coming down. Agency mortgages make a lot of sense here. TCW has basically almost gone all in, so to speak, on our agency mortgage positioning. We agree with your other guests that credit's not there yet. We're broadly neutral there. We did get a nice thing with Credit Suisse, but outside of that, we don't see a lot of opportunities.
Okay, so I think it was a portfolio manager from TCW who called those agency MBS a screaming buy, something along those lines. So makes sense there. But I do want to talk about a phrase that you brought up, sort of the normalization of the curve, because I'm looking at a 2s-10s curve that is a full percentage point inverted. It feels a far way away from normal. Are we at the depths of this inversion? Are we at peak inversion across these curves, or do you think there's more to go there?
Well, I certainly think there's more to go in the UK, in Euroland. I think they're underestimating the amount of tightening that's going to need to happen to really feel that they've knocked inflation expectations out. In the US, we're probably within 25 basis points of peak inversion. And the inversion has, again, it's the long and unpredictable lags of monetary policy. M2 growth, which people could knock looking at that in a million different technical ways, but it's been negative, I think, for 9 months now, more negative than we've ever seen it. It's working its way through the system. The problems in the regional banks is going to cause credit to be pulled back in many of the smaller parts, the small business areas of the economy. And I think all that adds up to, we're probably headed for, a recession. It's sort of the Kobayashi Maru, the no-win situation of fixed income. With this inflation, we'll raise rates until we have a recession. And I think that's what's happening.
All right, good place to end it. Really appreciate both of your times. That is Oksana Aronov and Laird Landmann. Thank you both so much. Up next on this program, it's the auction block. Issuance on a hot streak, especially in Europe. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where the sales remain hot. In fact, Europe, it's on its longest continuous streak of bond sales since October 2021. The record was set during a week that saw 21 billion euros of issuance. And helping to drive that number was NASDAQ, which had an offering in both Europe and the U.S. this week, saw sizable demand for both of those sales. And over in U.S. high yield, 6 companies lined up to sell more than $5 billion of bonds this week. There was an early rush in the week where Tuesday saw the most sales in one day since January. Meanwhile, Matt Miskin of John Hancock Investment Management says that now is a great time to look at higher quality fixed income.
There's just not a lot of risk being priced in. And right now, the time to fix a roof is when the sun is shining. When we look at portfolios that have been overweight risk, that have actually done well this year, you've had to have real risk on to do well and outperform this year. We would look to trim into some of this strength and redeploy into higher quality fixed income, take some chips off after such an exceptional run.
Joining us now, Ken Monaghan of Amundi Asset Management and Michael Contopoulous of Richard Bernstein Advisors. And Michael, I want to start with you because higher quality fixed income, I've been hearing that for months. How crowded is that trade at this point?
Based on all of the previous interviews, I'm getting a little bit nervous about it, Katie. But I think you're still supposed to be there. The question is what type of high quality assets, because they're not all created equal. So some will say that the investment grade market is a good place to be. I mean, that's high quality, certainly, but we don't think corporate credit is actually where you want to be positioned at the moment. So there's a lot of different types of high quality. And so I do think that you do want to be there, but you still have to be careful with which specific areas.
Well, let's talk about a specific area that I saw in your note, Michael. Agency MBS. You say that it's getting more attractive, but you're not yet all in. That was interesting because there was a great piece on the terminal this week from some of my colleagues quoting TCW saying that mortgage bonds are just screaming cheap. It sounds like that's not your view. What are you waiting for?
Well, they certainly are cheap, Katie, and the fundamentals are fantastic, right? I mean, you have virtually no default risk. You have no prepayment risk. All these bonds have extended, so you do have duration, but we're actually comfortable with that duration. But the problem is that we don't know exactly yet what the bank crisis is going to ultimately play out as. And if we have more banks and more bank selling of mortgage paper, that could yield ultimately, higher spreads in the asset class. I mean, you've lost your two biggest buyers, the Fed and banks. And so from our perspective, there's no rush here. I just don't see how spreads are going to rip tighter in the near term, given some of the technical and structural headwinds in the market. So I don't think there's a rush here. We'd rather have some certainty that the market has the all clear signals. And if we miss a little bit of upside waiting for that certainty, that's fine because of the fact that there are other opportunities elsewhere that are pretty attractive. But with that said, we are adding, but we remain underweight after having been very underweight last year.
Ken, come in here. When you look across the totality of the corporate credit market, where looks crowded and where is there still opportunity?
Well, I take your guest's previous point, which is that there's a great deal of value in the optionality of cash right now. There's not a lot of parts of the market that look exceptionally cheap at the moment. I think the comment that was made about mortgage securities agency mortgages looking screamingly cheap is accurate. And while they may get a little wider here, because you're right, we can't really tell what's going to happen with the banks and what's going to happen from a regulatory perspective. And the Fed's still a selling agent here. We would say that it's a pretty good entry point. When we're looking at investment grade corporate debt and we're looking at high yield debt, they're clearly trading at the tighter end of the range that they've been in the last 12 months. And we really can't pound the table for high yield in particular and say that it's screamingly cheap, because it's not.
Well, guys, entry points have come up several times in this conversation already. So I want to bring you Allspring Global's mid-year outlook. They wrote that falling rates should drive returns on IG bonds and adding duration should benefit portfolios when yields fall. They also write that the opportunity cost of waiting for a perfect entry point is high and it's difficult to time. So Ken, when you're thinking about entry points, specifically when it comes to duration, are you looking out the curve here or are you still staying in cash?
Well, when it comes to duration in the United States, we think we're getting to a pretty interesting territory here. Kind of in the 3 3/4 to 4% range. We haven't hit that magic 4% number. We think that that's the time to probably get in if we're talking about where the 10-year is.
Okay, so that's the time for the 10-year. Michael, weigh in on that. When you look across the curve, I mean, what is the case for duration here? And is that the case that you're making to your clients?
Yeah, well, let me first address the Allspring quote, because I couldn't disagree more, quite frankly. What I would encourage every single investor to do who's listening to this program at the moment is when they hear a comment like that, ask the portfolio manager where the returns are going to come from. And Allspring hit the nail on the head. It's coming from the risk-free component, lower treasury yields. So if that's the case and it's not coming from a collapse in spreads, why not just own the risk-free component, i.e. treasuries or something similar to treasuries? There's no reason to add spread risk if all your return is coming from lower, risk-free yields. And so from my perspective, there's no relative value at the moment, given where spreads are in corporate credit. There is relative value in duration. And I think a barbell approach makes all the sense in the world, where, you know, you can own front-end treasuries or AAA CLOs. You can own floating rate treasuries with 5-6% yield, and then barbell that with longer-term treasuries like the 20-year or the 30-year, and you get the total return potential of the long end coupled with the high yield at the front end.
Yeah.
You know, and I think you can do that today and feel really good about levels. And so from the instruments I just mentioned, we're there, and you should be involved in those parts of the market today. And high yield, I mean, I want to see high yield north of, you know, 800 basis points. I want to see IG north of 170, 180 basis points before I'm really excited about IG and high yield.
I really like that point. Just cut out the middleman. Just buy the risk-free rate. Ken, 30 seconds way in here. When you think about treasuries, what is the sort of valuation, the relative valuation relative to the corporate credit market?
Well, I take it Michael's point is that if you're looking at credit right now, it's not exceptionally cheap. You know, high yield spreads are, again, as I said, at the narrow end of the range. We've been running at about a 125 basis point range this year, where we're clearly, you know, about 425, 430 in that narrow end right now. We got as tight as just inside 400. We got as wide as 525. You know, at 525, 600 range, we'd say high yields are pretty attractive, because we think when we have a slowdown, which we're expecting perhaps as early as the fourth quarter of this year, it's going to be a relatively mild one, and high yields improved in quality over what it was 10 years ago. But we can't say high yield is cheap, and investment grade corporates right now are not either.
All right, guys, got to leave it there. Really appreciate it. Ken Monaghan and Michael Contopoulous, thank you. Still ahead, the week ahead. That's next. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up on Tuesday, consumer confidence from the Conference Board. Wednesday, we get the stress test results. Thursday, we get U.S. GDP. And then Friday, we'll round out the week with the Fed's preferred inflation measure. But let's talk about those bank stress results. The standards are tougher versus a year ago, so we'll see how the U.S. big banks fare. But from New York, that does it for us. This was Bloomberg Real Yield, and this is Bloomberg.